Cette conférence va maintenant être enregistrée.
So this conference is now going to be recorded. Hello, and it's a pleasure to see you all. I'm always happy to organize this seminar. So the next one will be with probably with Bill Lazonic, then we'll see Matthias Vernengo. We will also see Thomas Piketty, and maybe I also would like to invite in January and February a feminist researcher. So I invited a feminist researcher that one of you suggested, and if it's not possible, I will try and find somebody because I know it's very important, and I know this is lacking in EPOC, but we cannot teach everything. So for the moment, we are lucky enough to welcome the economist who predicted the global financial crisis, even if he is very modest. Even he would say that he predicted that thanks to his knowledge of Minsky simply. He won the Rivere Awards, I think you pronounce it like this, prize in 2009 or 10 for predicting the global financial meltdown in a paper published in 2006, right? He's very modest. He's also a good friend of mine. We are not gonna try and hide this, right? He's the only guy on earth with whom I ever brought a bottle of wine at the restaurant because it was in England and English people don't know what proper wine is. I will always remember that. It was a very funny evening. And he's also, yeah, one of the most brilliant post-Keynesian economists we have. He has become independent now. He has been in Australia for a while, then he moved to Kingston University. He is the one who hired there some people you will meet in the second semester, the M2s, namely Antoine Godin and Evrim Yilmaz, who are now teaching in EPOG also as member of the French Agency for Development. So I could spend hours telling praises about Steve Keen. We wrote a paper in 2018 in the French press predicting the next financial meltdown and so on and so on and so on. And probably we'll write other papers together, whether academic and from the press. And today he has accepted, despite of the very late hour for him, because he's in Thailand, to present his last paper. And so there will be, I'm not sure whether there will be 3 discussants or 2 discussants. Raphael, will you be a discussant or not?
Yes, I've made a couple questions, just a simple thing.
Okay, so you're lucky enough, Steve, to have 3 discussants, including Raphael, who's very active. And I suggest that we start now. And Steve, the floor is yours. You have 45 minutes to 55, maximum 1 hour, if you don't mind.
Sure. Okay.
Then you will have to deal with a very serious discussions we have in EPOG, and then we'll open the floor to our colleagues and to the other students. Thank you, Steve, again.
Okay, thank you. Okay, well, I'm looking at the way that economics has become a religion around equilibrium. I'm sorry, actually, I don't know if I can actually shut these or close the visibility of these meeting controls on the right-hand side because they're obscuring part of the screen. I actually do that. Do you know if I can get rid of those over here?
Steve, it's fine. Yeah. Don't you worry, because
you can see it.
I'm on a 13 inches screen, and it's perfect. Right. It's okay.
All right. Okay. So if you see where economics began in the neoclassical tradition in the 1870s and 80s, equilibrium was seen as something they were using just because they couldn't do dynamics. And unfortunately, and they believe that their successors, this is J.B. Clark who gave us the marginal productivity theory of income distribution, believed that their successor would move from statics to dynamics. And it didn't happen. And one of my favorite books by an author called John Blatt, I highly recommend you to search his now recently republished book, Dynamic Economic Systems, on Amazon. It's just been released again after 20 or 30 years. And he made the quip, what I thought was a quip, that capitalism may disappear before dynamics are understood by economists. Now, economists could claim that they've developed dynamic stochastic general equilibrium models since then, and Blatt didn't know what he's talking about. But I love the comeback from Paul Romer when he, just before he won the Nobel Prize for economics, wrote this beautiful put down of mainstream economics. And he said that it has such a non-committal relationship with the truth that it can't even be called postmodern. It deserves being called post-real. So we're in a dreadful state. And Yanis Varoufakis and Arne Asperger, I think it was, gave a brilliant explanation for this back in 2006, saying that it's a magnificent failure. Okay? Its failure to prove the conditions for equilibrium actually made equilibrium more of a belief system. They had to preserve equilibrium somehow. So you look at Walras's tautonement process, which he thought would converge to equilibrium over time. The Perron-Frobenius theorem from mathematicians, nothing to do with economics, by talking about the stability properties of a matrix consisting of zeros or positive numbers, proved that either the price vector or the quantity vector was unstable, so you wouldn't get the process converging. The solution? Let's talk about restricting the initial values of the disequilibrium variables. To assume we start from heaven, we're never going to become devils. Well, that's really useful. That's a sort of, and there's also mathematical errors in the argument as well. Then you look at the Ramsey growth model, which is the basis of modern DSGE and RBC models, and that's also at an unstable equilibrium. It's actually a saddle. Imagine trying to throw a ball bearing on a ping pong ball onto a saddle and having it rest on the saddle. It's not stable. So the solution was to assume the existence of omniscient agents who could locate the stable fork of the saddle and jump directly on the back of the spine of the horse and not slide off. If you can do that, you don't need a market. So rather than accepting these processes of non-equilibrium, they added these, what they called simplifying assumptions to fudge equilibrium. But if you look at what's going on there, simplifying assumptions are things that if you leave them out or if you include them, make a trivial difference to your conclusions. So if you look at whether Galileo would have had a better proof that objects of different masses fall at the same rate, will have a better result if he evacuated the air around the Leaning Tower of Pisa before he dropped them off the tower. It would have made bugger all difference. Right? That's what a simplifying assumption is about. You don't worry about air resistance when you're dropping 2 lead weights out of the Leaning Tower of Pisa. But the neoclassicals apply that to what Musgrave called brilliantly domain assumptions, where if the assumption is false, then so is the theory based on it. And what you've had is this defense by indefensible assumptions all the way through, leading also to a fetish about the people who didn't understand how badly founded their micro was, to then say we should reduce macro to applied microeconomics. And this is Lucas giving a talk in the year he became president of the American Economic Association. So we should make macroeconomics microeconomically founded. But if you look at science, just could they do that? This is the Sonnenschein-Mandel-de Boer which describes whether you can derive a downward sloping market demand curve by aggregating demand curve of individuals who all have downward sloping demand curves. And the answer is no. It can have any shape at all, any polynomial shape, any continuous function. And textbooks frankly lie about this. And my favorite is by 2 of my favorite liars, Paul Samuelson and William Nordhaus. And there's discussion here by Samuelson, as it happens, not Nordhaus, originated this one. The market demand curve is found by adding together the quantities demanded by individuals at each price. Does the market demand curve obey the law of downward sloping demand? It certainly does. Bullshit. This is the summary of the result of the person who found it, saying every continuous real valued function is approximately an excess demand function. So anything you can draw by holding a finger on a piece of paper, not lifting it off the paper, not going above yourself and not crossing over yourself, that's a demand curve. It doesn't have to slope downwards at all. And how did Samuelson reach this proof? I couldn't believe it when I finally read it. He said, all we have to do is assume that there's a benevolent dictator who optimally allocates real income before trade takes place, so we all believe the ethical worth of each person's marginal dollar is equal. Let's assume that. Let's assume a benevolent dictator to make capitalism work. And when you look at the philosophical foundations, can you actually derive a higher level science from a lower level science? There's a brilliant paper I highly recommend reading by a physics Nobel laureate, therefore a real Nobel Prize, saying that there's a belief that you can array sciences so that the entities of X obey the laws of science Y, but that doesn't mean you can construct science Y from X or X from Y. You can't do it. As a complexity and scale mean this is impossible. Psychology is not applied biology, nor is biology applied chemistry, and equally, nor is macro applied micro. So the whole process is futile. The foundations themselves are fictions. They're either false, rising marginal cost is not reality. For most firms, marginal cost falls, or incomplete. Impossible, you can't have complete preferences. There are simply too many dimensions for that to be feasible, and you can't derive the higher from the lower. So it means that you cannot micro-found macroeconomics. But does that mean arbitrariness? And that's what they're always afraid of. Blanchard talking about what to do after the crisis is one of the more approachable and reasonable neoclassicals on this front. He and I have occasional conversations, direct discussions on Twitter. He said, starting from explicit micro foundations is clearly essential. Where else to start? Well, and then he says how long it's going to take to get to something reasonable. So to set of distortions to a competitive economy, a long slog. It's hard work, and he's right, it is hard work. A waste of time, but hard work. So I say, let's try starting from macro and self. And I can show quickly how the model which I built my model of Minsky's financial instability hypothesis, Goodwin's cyclical growth model, you can derive it directly from macroeconomic definitions. So I use omega to describe the ratio of wages to GDP, and that's defined as being that ratio. And a simple rules of mathematics, you go through the product rule and so on. If you have the rate of growth of a ratio, so 1 over omega, the omega dt, which I show as omega hat there, is equal to capital W under hat minus y hat. That's a straight, simple rule of expansion of a product rule expansion for that fraction. Ditto for if you define the employment rate as the number of workers with a job divided by population, you get the rate of change of employment is the rate of change of labour minus the rate of change of the population. If you assume a uniform wage, then you can expand the wage bill into the rate of change of wages plus the rate of change of workforce. I use typically just a simple linear Phillips curve. Phillips himself insisted it had to be non-linear, but this is, you can have linearity here and still get a non-linear model. I use the output to labour ratio, which I assume grows at a constant rate, so what we call technological change, a constant capital output ratio, and assume that all profits are invested, which is the assumption that Goodwin made. Then what you did by substitutions is this simple model. The rate of change of the employment rate is actually the growth rate minus the sum of labour productivity change and population growth. And the wage share is the rate of change of the wage share is the wage change function minus labour productivity. Now you put that together and you get cyclical growth. You don't approach the equilibrium. The equilibrium is actually neutral, neither stable nor unstable. And I've done the same thing and added one more definition, which is the ratio of private debt to GDP. And then again, the same ones I had before, output employment, capital output ratio, and differentiate that, and you can actually make verbal statements about this. So these are definitions, but in terms of rates of change. So the employment rate will rise if economic growth exceeds the sum of change in the output to labour ratio and population growth. And the wages share will grow if wages grow faster than GDP. But also the debt ratio will grow if debt grows faster than GDP. Again, they're simple statements of fact. Now you add simplifying assumptions, the ones I've used beforehand, plus I add investment being a function of the rate of profit, and debt being used to finance investment when it exceeds profit. And what you get is this set of equations, one more added down here, that's the change, a debt ratio function. And when I simulate this using my Minsky software, what I get is a system that appears to converge to an equilibrium and then diverges. It has the classic strange attractor effect. So if I make this a bit larger here, hang on, and simulate, then what you see looks like what the neoclassicals call the great moderation. There's a period of diminishing cycles. Looks like the economy is getting more stable. But as it's happening, you're also getting a rising level of debt to GDP and bankers' share of GDP rising. And as that continues, those diminishing cycles become rising cycles again. And if I run the model for long enough, you get a level of debt that overwhelms the capacity of the system to finance that debt, and the system breaks down. And you also see, they can see quite clearly in this plot over here with the green plot, where I've got the wages share of GDP on the horizontal and the debt ratio on the vertical. Even though the workers are not doing the borrowing in this model, they're the ones who are paying for it by a falling share of GDP. So the income distribution dynamics are driven by debt and actually mean that workers get lower incomes because of rising debt levels. That's leading its way to its breakdown there. Now, if I've generalized it to include rates of change of prices as well, price dynamics, nonlinear behavior as well, and I get a richer, more complicated model, which is only the beginning of modeling the economy as a dynamic non-equilibrium system. Again, given time constraints, I won't run that model there. But a part of what I've got to now explain is, why does credit have a role in aggregate demand? This is something I've been working out for about 10 years. I finally got it right. I made a few mistakes along the way, which Mark Lavoie told me about, and a few others. But let's imagine you take an economy and divide it into X sectors and show expenditure on the left, on the horizontal, and income on the vertical. So what you have is, on each of the diagonal of this table, the negative is the amount of money being spent per year on the other sectors by the sector we're looking at. So the negative of the sum of the diagonal is aggregate expenditure. The sum of the off diagonal is aggregate income. And if you look at a world in which there's neither borrowing nor banking, then you have household spending A dollars per year on services and B dollars per year on manufacturing. Services C on households and D on manufacturing, manufacturing E on households and F on services. When you add up either aggregate expenditure or aggregate income, you get exactly the same term. This is the identity of expenditure and income. If I include the myth of loanable funds, which neoclassicals still believe, then what you have is credit dollars per year being lent by services to households who then spend that on manufacturing. And then when you work it out, you find credit cancels out. This is a negative entry for credit on expenditure. This is a positive. They cancel each other out. This is, again, the same story on expenditure. Positive here, negative there. So they cancel out. And what you find is interest turns up as part of expenditure and income, but not credit. And that's the world neoclassicals live in. Now, when you include the real world where banks originate debt and money, then I've got to include the banking sector in here as well. And I have a bank lending credit dollars per year to households who then spend that on manufacturing. So I'm now showing the assets of the banking sector on the left-hand side and the liabilities and equity on the right-hand side. And there's credit increasing the assets, increasing the liability. There's no offsetting positive term here on the diagonal, and there's no offsetting negative term on the off diagonal. So when you do your summation, you find credit as part of aggregate expenditure and aggregate income. So that's logically why it has the role that it does. Credit doesn't cancel out. Now that's what neoclassicals are missing by the model of loanable funds. That's why they can't see capitalism coming. Now, when you look at the mindset of neoclassical, Tony and I don't get on too badly. We had a big fight at one stage, but then we actually became quite pleasant towards each other because the guy's suffering from RSI, a rather bad fate for anybody. But here he is going back at macro saying, people who touch macro lead people through simple models without money, okay? And that's better, leave them out, even with banks without money, yeah. And here is Paul Krugman saying, why does the Bank of England paper saying that loanable funds as false actually matter? Let's stick with loanable funds. Now, of course, if you take a look at the data, the evidence, of course, confirms the neoclassical case not. There's a monumental negative correlation between credit and unemployment, which shouldn't exist, according to them. So the data violently rejects their assumption. The same with when you look at history. Can you see these crises coming? Yes, you can. It's when there's too high a level of private debt, too fast a rate of growth of private debt, followed by a slump where credit goes negative. So there's the Great Recession, with credit going negative for about 2 years. There's the Great Depression, with it going negative for about 8 years and hitting minus 10% of GDP. And a thing I didn't even know about until I created this chart, the Panic of 1837, when credit was negative for a substantial period, longer even than the Great Depression. So that's a sign the biggest crises in America have been with negative credit. Then you look back at the pre-Second World War period. Over that period of time, there were 13 negative credit events. There's only been one since the Second World War. So there's been a structural change in the economy as well. So all this stuff they say is just because they don't understand the real world. And they also say there's no difference between loanable funds and endogenous money. I'll demonstrate this model because this shows off my Minsky software that I'd like you as students to use. And what I've done here is set up a simple model of loanable funds. Pardon me, part of the table here is not showing properly. I'll just stretch that a bit. I've changed the layout. Minsky's layout has changed a bit, and I didn't realize I'd lost some room here for some text. So I'll just fix that up, make it a bit larger. Pardon me. My girlfriend gambles, so occasionally that sort of stuff turns up on screen. Okay, this is a simple model, let's go back again now, of loanable funds. So I have the capitalist lending to the firm sector, firm paying interest back to capitalists, and firms repaying capitalist lending to them, and then the bank only getting money out of an introduction fee, and then wages being paid, dividends, consumption, and so on. And if I simulate this model, and I increase the rate of lending and decrease the rate of repayment, so debt increases quite dramatically. There are changes to GDP, but they're fairly minor, and they go in the opposite direction. If I go back down again, a huge increase in debt, it goes into a fall in debt, and there's a bit of a change in income. It kind of goes the opposite direction. But the changes in income aren't all that large. So with this sort of model, you can say, well, there's no point in bothering including banks in macroeconomics. But if I go in here to Minsky and say, let's bring some realism in here, it's not true that the banks, that the loans are an asset of the capitalist class. So I'll bring up the capitalist Gottlieb table here. And what I can do with Minsky is simply delete loans as being shown as an asset of the capitalist sector and delete the monetary transactions as if they're actually happening between capitalists and the firm. They're not. The banking sector is the one doing the lending. So get rid of that. Change the, make space for an extra asset for the banking sector. Include loans, which are still there as a liability of the firm sector. Interest payments are now made to the bank and there's no fee. Now I haven't made any other changes to the model, and I run it and simulate it again. And what I get in this particular situation is a plunge in money coming out of the system with the conventional hours I've got it. So I'll slow down repayment, start again and see what happens. And what you get is a completely different type of economy. If lending accelerates, so it looks like I've stuffed up this particular model. I was just realizing I must have made an error in the logic of this one. I'll come back and show what I had properly beforehand. And that is that's loanable funds. And when I change it to endogenous money, I get a completely different outcome. I get the debt driving the economy and the economy, GDP moving in the same direction as the level of debt. So I now want to show that you can combine the debt-based analysis I do of money with modern monetary theory. And that is now including a government sector running a deficit. And the deficit increases the assets of the banking sector, increases the liabilities at the same time, so it creates money. And that then gives excess reserves, which the banks are happy to use to buy bonds. And then with the bonds in their possession, they get paid interest by the Treasury, which adds to their equity. And then I have the banking sector also lending credit to loans, which can be positive or negative. Interest is paid by the firm sector, wages, consumption, etc., coming out of that. And what Minsky is doing is building a set of equations that are all accurate. So you could never try to do this by hand, but the table makes it quite straightforward. You then model this by defining the flows, and I'm happy to give a tutorial at some stage on doing that. And once I've done it, and I think this one is properly set up, then if I have, say, this is a deficit of minus 1% of GDP, which is a surplus, and that's what Calvin Coolidge thought made the 1920s so great. But at the same time, I've got credit running at 5% of GDP, which is actually why it made the Roaring 20s so great. So you simulate this, and you get a growing economy coming out of it, which is what Coolidge thought was due to his surplus. But if you get rid of the credit being created by the banking sector and just have the surplus alone, what you get is an economy that crashes, because the government surplus is taking money out of the economy. If, on the other hand, you run a deficit, a genuine deficit, then you get an economy that grows, because what's happening is the money is being created by the government, increasing the worth of the private sector and enabling more economic activity by the existence of more money. So I can also, this is a more elaborate model again, where I show that when if you have the government running a deficit, that is creating money and creating net equity for the private sector. And so this is the sort of modeling I want you students to start working in this sort of work, because this is a way to mathematically blow the neoclassicals out of the water with monetary macroeconomics, which is logically well-founded and which is actually relatively simple to build. This particular model took me under a day. So rather than the long, hard slog that Olivier Blanchard sees himself facing to try to build a similar sort of model in DSGE world, it's extremely fast to build these models, and they're much, of course, they're realistic, whereas the DSGE models are a fantasy. So that's, I'm going to finish with the final part of work I'm working on as well. One of the great weaknesses, not just of neoclassical economics, but post-Keynesian as well, is that we are not consistent with the laws of thermodynamics. And as it was said brilliantly back in the 1920s by Sir Arthur Eddington, who's the person who confirmed the general theory of general relativity experiment by observation. If your theory is against the second law of thermodynamics, I can give you no hope. And that's the state of both neoclassical and post-Keynesian economics, because they have ignored energy. And my little insight that let me realize how to bring it in was a simple observation that labor without energy is a corpse, or capital without energy is a sculpture. You need energy to motivate them both. So when you do that, you find if you take the neoclassical production function, Cobb-Douglas, or the post-Keynesian, and you replace K and L with capital and labor as driven by inputs of energy, then the simplest thing to say is the amount of the labor is going to be the number of workers multiplied by the energy consumption per worker, multiplied by the fraction of that energy that is turned into useful work, and exactly the same concepts for machinery. Then what you get is a Cobb-Douglas production function, where what's called the technological coefficient part of it, the A, disembodied, I think what they call a Higgs neutral technological change. It's actually the energy contribution of the typical machine of a particular age. When you put it in the Leontief term, it doesn't change as much, which is a good thing. But your capital output ratio becomes your efficiency of turning energy into useful work. Now, you can also trash the Cobb-Douglas production function, and again, I'm going to race because of time here. You can, and of all people, I actually find I like some work done by Mancure. The first time I've ever said that. But he looked at the cross-country data and said the only way to make the Cobb-Douglas production function consistent with cross-country data is to have the capital share, rather than being 0.3, which is what they use based on income distribution statistics within a country, make it 0.8, okay? Which means capital labour goes from 0.7 to 0.2. Okay, so it's a very large change. But even with that, when you look at the correlation between the annual change in energy and the annual change in GDP, it's too tight. It's too close. You can't fit it, even with the 0.8. It's got to be higher. In other words, your Leontief function is best. Okay. This is a data fit. This is energy in millions of tons of oil equivalent from one data series, and global GDP, US dollars in 2010, from another data source. It's almost a straight line, and those two straight lines, the very easiest way to fit it is just simply a Leontief production function. So what I then show is, and this is work I've been doing with Matthias Criselli and Tim Garrett, is that if you look at an energy-based function, which is what the Q is about, versus the existing function, and you then equate your terms, what you find is your energy conversion factor there is the energy consumption of a typical machine, and your capital output ratio is the efficiency with which you convert energy into useful work. What we get out of that is the version, we haven't done a Minsky version yet, this is a Goodwin model, a revised version, pardon me, of the Goodwin model with exactly the same dynamics. But I can now include resource depletion and pollution feedbacks into the model. And this is a simple model of that system, where you've got your energy coming in over here, depleting the available reserves, being processed by the existing machinery, turned into useful work, output here, etc., employment rate, wages, blah, 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 profit, and then investment again. But you're getting resource depletion at the same time. You're producing waste necessarily, and you have this finally a collapse in the economy when you run out of the reproducible resources. That's not the fate that I just expect in the future. The oil age won't end because we run out of oil, okay? But it is a potential way to show this resource depletion effect and pollution effect as well. And the final thing we've done, which is a bit of fun actually, is we wanted to include the complete reality that isn't just energy as an input, it's energy and raw materials. And this is the very first step towards having a multi-sectoral, multi-commodity model of capitalism using energy. Hicks tried to do it in 1935. This is actually the paper that ended up giving us the ISLM model, as he admits in 81, 82. And he had a model in which you had bread produced by labor plus equipment. And that was on the road to what we're talking about. But he ended up reducing it to the stage where capital was dated bread, which sort of implies you can use stale bread to make fresh bread. I'm sorry, you can't. It just doesn't make sense. So it's easy to imagine bread as a consumption good, but really hard to imagine bread as an investment good. So he didn't actually produce a useful model. So our solution, and I rather like this one, one I dreamt up one night, this may have a fictional consumer good, but a semi-realistic investment good. And there's actually a movie called The Iron Giant, okay? And of course he eats iron. So I imagined an iron planet where the workers are all iron giants and they consume iron, okay? But you can also use iron to make the mining equipment for mining the iron ore, the mining equipment for the energy, and the machinery to turn the iron ore into iron plus slag. And then also these iron giants then eat the iron. So you have energy mine, iron ore mining, smelting and rolling of iron. They're all using energy as their motive force, but they're producing different yields. Now, I won't go into the full logic, but because you can use the conservation of energy now, then I can equate those terms. I have an idea that there's no energy stocks. Conservation of matter means these terms are the same. And by doing all that, you finally end up having a novel solution to the aggregating capital, because capital is actually weighed in kilograms of iron. Okay? So there's your aggregate capital. That's the number of machines. That's the weight of each machine. So that's an aggregation system. And then you can use this equation to include the energy consumption, the same for material, and you can then work out what your yields have to be. This is something which can be made much more flexible, by the way, to having price functions and buffers inside there, but it's a first pass at getting a general model of energy and matter consumption. And what we're getting in was yet again a version of the Goodwin cycle model, but it generates both iron ore and waste in terms of slag. And so if I simulate that, I get the same sort of cycles. I'm getting waste produced. I could show depletion of the two minerals as well. It's only just an extension of the model. So that's all, I think, feasible to extend economics, make it consistent with the laws of thermodynamics, get the monetary side right, do the dynamics, get away from equilibrium. It's all possible. Why don't we do it? And that's the question. Why does economics not advance one funeral at a time? And if you look at Max Planck, who actually made that quip, I bought a couple of his books. I want to read. The man's got a brilliant sense of humor. And he said, a new scientific truth does not triumph by convincing its opponents, but rather because they die and a new generation grows up that's familiar with it. Now that doesn't happen in economics. But if you look in what happens in say, Ptolemaic astronomy, then they had a model which is completely wrong, but still managed to fit the data. But over time, it couldn't help but accumulate anomalies. And my favorite actually is because the model was based on the idea of heaven as being perfect and earth being where decay happened, then what are comets? Well, it turns out, according to Aristotle, and the Ptolemaics maintain this, they were atmospheric phenomena. Okay? Nobody knew how far the atmosphere extended or what it was made of. So, but when Halley's Comet comes back, predictable, then there's something wrong. Now, that wasn't the actual, the anomaly that knocked over the Copernican world, but that's the sort of thing which happens. It doesn't make Ptolemaic astronomers become Copernican. They remain Ptolemaic astronomers. It's simply too big a leap for them to do it. So what actually happens instead is that they are the previous paradigm and they can't get a new bunch of students to join them. So if you look at the experiment that undermined Maxwellian vision of electromagnetism and so on, it was the argument that how does light travel through a vacuum? And they believed there had to be a substance called the ether. But the Michelson-Morley experiment showed there was no ether. Now, relativity explained the movement, but pre-relativity and pre-quantum mechanics, people couldn't accept this. So they continued teaching the old paradigm, but the students would knew of the anomaly. The anomaly didn't disappear. They could reproduce it themselves in laboratory experiments. It was always there. And as students, even though the teachers are teaching them the old school, they will pass the exams, but they won't believe the old school because they know it can't resolve this paradigm. So they're trying to work out and resolve this anomaly while the old school is teaching them the old garbage. Now, eventually, the old scientists retire and die. The new students take over, and they're committed to this new paradigm. That's why science advances one funeral at a time. But it's punctuated. You have an established paradigm, an anomaly. The established scientists resist it. The students can't be persuaded to ignore the anomaly. A new paradigm is developed. The old scientists die, the students replace them, and they bring the new paradigm with them. So there's a paradigm shift. But in economics, we get anomalies, but you can ignore them. Why? Because they're only one-off. You can't redo the Great Depression and try Austrian policies or Marxian ones. You have new events that come along and supplant how important they are, and you gloss over the theoretical failures. So you have this, even Samuelson conceded defeat in the capital controversies. And you would imagine after that, well, he must be talking about his textbook. No, he doesn't. Okay, they still teach the marginal productivity theory of income distribution, which they've undermined. So they want to ignore the anomaly. They want to forget about it over time, and they can find enough students to do that, to go along with them. Now, some students, the Hyman Minskys, ask a different question and end up with a totally different paradigm, and they get a few followers, but we're marginalized. Danny and me and all the S, we're ignored. And we never replace the neoclassicals. They find a new bunch of retards to, I didn't want to insult us. I think you guys insulted autistic people, didn't you, about 20 years ago? I'll use something else. So economics is pretty scientific, but the old paradigm can find new believers. The vision they have is seductive. Don't leave out, don't forget the extent to which this is desiring an anarchist autocracy, an anarchist world. There's no power. It's all done by distributed systems, and everybody gets what they deserve. Now, that's an incredibly seductive vision. It's an anarchist utopia, and that sucks in these new students. They do all the mathematics stuff. They think they're fancy, and the old paradigm continues on. We form heterodox schools. We're in a we're in the minority, we have poor funds, we're in lowly ranked universities, etc., etc. The revolution doesn't take place. Paradigm shift does not occur. So that's the neoclassical disease. And we're stuck with it. I would often advise students to do system dynamics and forget about economics. Okay, let's bring the new methodology in. So, pardon it, I know it's a long presentation. That's it. How do I stop sharing screen here, Danny?
You just I will set another presenter, so the screen will be shut off.
Okay.
So thanks, Steve, for this very stimulating presentation and for this very interesting conclusion that I pretty much share, right? We are still prehistorical, not prehistorical, but we are still stuck in the old paradigm, which is completely false. And I guess that most students that are here share this view, or at least can see the failures of the neoclassical theory. So now we have 3 discussants, and do you have slides?
I myself, I don't. I just have. I'll just ask my questions. You know, I have them written down, but nothing to present.
And Vitor, do you have slides?
I don't.
You don't. Okay. So just go ahead. Try to keep it within 15 minutes if it's possible, because it's already very late for Steve. And as Steve criticized MMT, I guess there will be questions. You know, this new generation is very MMT friendly. And okay, so please, you free go ahead with your questions, and Steve will respond, and then we'll open the floor. Please.
Okay. Should I start? It's okay. Okay. Well, my questions are mostly about the model itself. I was looking mostly, for example, at the simplifying assumptions. You know, you use at the Minsky model. You know, to derive from the macroeconomic definitions. And some of these assumptions were kind of puzzling to me. For example, when it comes to the simplifying on the investment equation, it seems that the gross investment cannot go below zero, like usually doesn't. We don't see in the real world. So it seems the equation imposes a limit below which the profit rate can't fall, unless you are assuming that the capitalists could scrap, like disinvest capital if the profit rate is too low.
That's just a side effect of it being a linear expression. I don't use linear. Okay, it's linearity. It makes it easy to work out the eigenvalues. It's when I do a proper model, it's all nonlinear functions.
No, that's not really a big issue. I mean, scrapping capital, it does occur, for example, I think in the shipping industry, for example. We have seen a lot of it in 2020, for example, but it's kind of weird to think of it on a macroeconomic scale. But anyway, my biggest issue with this equation is that you choose the profit rate as the main determinant to explain the investment, right? Or more precisely, the investment to output ratio. And I was wondering, what role does expectations, animal spirits, interest rates, and the capacity utilization, what role do they play on this model? Are they somehow implicit? Because it's kind of like when we consider nowadays all this this debate on financialization, it seems weird to me to choose the profit rate to explain investments when we are actually seeing like these two variables moving apart from each other, right? You see companies like Apple, Facebook, and so on. They have more and more profits, yet the investment rate seems to go on the opposite direction, right? So
yeah, well, there's still a fair bit of empirical data. I actually don't even know if people family in French to show that the main source of concerns looking from the corporate sector alone, the main source of finance for corporate sector long investment of long-term debt. So you get a fairly, that argument is saying that the rate of change of debtors investment minus profits is actually fairly consistent with the data, okay? Number one. Secondly, if you include the other, what I'm trying to build is the simplest possible model. Don't think that's everything I think about the nature of capitalism, okay? It's just, I see that model as being like Lorenz's model of the weather. Lorenz took the Navier-Stokes equations, I believe, and reduced an 11-dimensional partial differential equation system into a three-dimensional ordinary differential equation system with 3 constants. Okay? Now, it wasn't because he believed that was the weather. He wanted to get down to the fundamental source of instability in a weather system, and that's where we got the idea of complex systems coming from. Same thing for this model. It's the stator. You don't stop there. It shows if you have the best possible use of debt, which is that it's used to build factories, okay, and you have the best possible situation, full capacity utilization, etc., you can still have a debt crisis. Now, if you add in other stuff, you'll have a faster debt crisis. If you include speculative investment, the sort of, if you use share buybacks and things like that as well, then you're getting extra debt with no extra capacity to service that debt. So you're going to accelerate what I've shown you there. So, this is the best case scenario. If somebody, can you mute them? There's a fair bit of chat going on there. Danny, where's it coming from?
I'm gonna cut this. Except unless Raphael is organizing a party at this one. But,
So the other students, because that all, Raphael?
No. I just can I make just one more question?
Yeah, sure.
Is regarding
with Raphael.
It's about the credit equation. And it was not so clear when I read it. How does bank select like who is worthy of receiving loans and who is not? And like the equation gives them the impression that the credit is granted to anyone seeking money, like for more investments. And I was not understanding how does the reversal in the cycle happens, the Minsky moment,
You mean from the logical statement I had there, the Moore table, the tabular, the three sectors, household sectors, and services, manufacturing. Do you mean that table, Raphael? Which table do you mean? Do you mean my when
no,
I
it's not in the table. It's in the model still. It's the equation regarding the credit granting. It's about the change in debt.
Change of debt. Okay,
yes.
But that's an aggregate expression. Okay, I'm not worried about how banks assess credit availability for individuals. That's debt at the actual national level. So there is a rate of change of private debt, and all I'm doing is the first approximation, saying the rate of change of private debt is investment minus profits. And of course, it's a whole lot of other stuff as well. Okay, but if you add that to it, you'll strengthen my results, but bury them in more detail. And there's a reason that you start with simple models, because they clarify your potential dynamics by leaving it to the structure rather than to the embellishments. So you can go, please. I'm delighted to have people add other elements to it. Okay, it's not that I don't want them there. It's just that I don't want to start with them.
Okay, Raphael, is that all?
Yes, that's.
Oh God, it's already Christmas. No, I'm kidding, don't worry. You're always raising lots of interesting questions, right? So who is next, Victor or Selma?
It's me, Victor. Can you hear me well?
Yep.
Okay.
Okay, good. So first of all, I would like to thank you, Professor Keane, for this very interesting and enlightening presentation, especially on the software to model Minsky. And if you could possibly do the tutorial, as you mentioned, afterwards, and then Danny can arrange it for us, it'll be quite interesting.
Okay, sure.
So yeah, one thing also, it's following a bit on Raphael's argument on the investment function. This is what bugged me a little bit more, was about actually what you mentioned already, was the capacity utilization and ways to incorporate it. Because in the model, the results that you find without including capacity utilization, as I understand, was two different results. One with exploding debt, and the other one with stagnation, sort of stagnation. What I think was that I think on if you include capacity utilization, you possibly can find four outcomes. One of which was like high profits and high capacity utilization that would lead to high investment and would be the reinforcing the reinforcing of the system. High profits and low capacity utilization, which is probably what is happening today in the US, when you see what Rafael mentioned, for instance, prolonged periods of low growth and where the increasing indebtedness is being used to finance stock buybacks. Also low profits and low capacity utilization, which would lead to a downwarding system, low investment and low aggregate demand, and ultimately low profits and high capacity utilization, which is something that we experienced in Brazil a couple of years ago because of and then due to the overvalued exchange rate, we suffered for a profit squeeze. Then even though there was a high capacity utilization, because of low profits, investment was shut and the economy went downward. How do you think? Do you think these are the only possible results of incorporating capacity utilization, or do you think what can be done?
I suggest you add it to the model and find out. I included variable capacity utilization in my PhD, and I included government spending as well. And so it's quite feasible to do that. It's just that, again, as I said, I'm trying to give a foundation to others to extend. So I'd be very happy to have somebody else include capacity utilization inside there and see what it does to the model.
Okay. Yes, this is because I thought I didn't run the model, so I don't know what the possible outcomes would be. And second, I have another question is how to incorporate in this Goodwin-Minsky type of model the open economy. So how would this behave, for instance, for developing economies where the credit cycle in the core countries lead to an increasing in aggregate demand in the periphery, and then thus by reverting expectations and so on, this creates a credit crunch.
That's a huge increase in complexity, because what you need to do to model it properly is at least two separate Minsky models linked together. Okay, there's exchange rates and international capital, and preferably three. You want to have like a major core economy like Australia, like a USA, a minor one with a trade deficit like Australia, and then the developing economy. So you get a huge increase in the structural complexity. And Minsky has been, I haven't even attempted that yet. I've got it in my mind an idea of what to do, but that's at least. You have at least three countries, real monetary flows, different commodity structures. It's a giant job. Okay, so Minsky, the ambition in building Minsky has always been to get to the capacity to make that feasible. And the idea I'd like to have is to have a valid model of production at a national economy level, and then we work out what all those structural elements are. So you're going to have currency conversion going on. You're going to have commodity flows. Have costs of transportation, okay, et cetera, include all of that and automatically generate it. So you build a model of one economy, click a button, how many sectors do you want, how many other countries do you want, Minsky will build the whole thing for you, okay? Now, I haven't had the time or the funding to do that, but I don't think it's feasible to even imagine doing it in a by hand method. You could give it a try. It'd be intriguing to give it a try. If you imagine, again, I'd set up godly tables to do it rather than try and doing it in raw differential equations. But you then have to have a set of godly tables describing one national economy and another national economy, and your exports and imports. It'd be a big job. Worth doing, but that's several PhDs.
Yeah, I was imagining because to predict, for instance, global recession, or for instance like this global credit rising and in a global scale, not only, but I guess if you only do that for a core country, for instance for the US, which is the one that it has the most developed financial system, then you can also imagine that a crisis in the US would lead definitely to a crisis in the developing countries as well.
Yeah, definitely.
Okay.
Yeah.
Just for your information, a few years ago, a former student here at Sorbonne Paris Nord did extend the SFC models to 3 countries in order to try and assess this kind of effects. And as a matter of fact, Marc Lavoie, who was member of the board for the PhD, said he barely understood what had been done there. So if you do that, you need many Steve Keens, many students, right?
Okay, we wait for another reincarnation or something. Okay, thank you very much.
And by the way, you should know that the model you will study from the French Agency of Development with Antoine, Devrim, and so on has been inspired by Keen and what's his name again, Goodwin. But they insisted on adding the demand side. So maybe some answers to your questions will be presented.
Actually, that's a very good point. Yeah, I mean, I know Devrim and Antoine are both friends and staff of mine at Kingston, two of my best hires. And I think last time I spoke to Devrim, it was the 34 or 45 equation system of differential equations, enormous monster done in Mathematica. So it can be done. They probably have done it. Okay, but the level of the sophistication and work involved in that is huge.
Yeah.
So get sitting organised. Have you got Devrim or Antoine giving a presentation, Danny?
Yeah, Devrim and Antoine will be giving a presentation of the GEM model. That, as you know, is an SFC model in continuous time, and the basis is Goodwin / Keen.
Yeah.
So
when you're doing the presentation, I'm sure the hour is going to be bad for me, but it'll definitely record it so I can watch if I can't actually attend.
Yeah. Okay. I will hook you in, and if you want to give a tutorial about Minsky, we can arrange. Right? That would be great. I would be interested too.
Good.
So
earlier in the day.
Last but not least, before opening the floor, now we have a lady named Selma. Please.
Hello, and first, I really wanted to thank you for this presentation, and I really enjoy read the papers, and I even download Minsky and try to use it, but it was a bit of a disaster. So my two colleagues until now, they have asked specific questions about the models, and I would like to add maybe a more policy-oriented side to the discussion and see how this discovery can be used to improve everyone's daily life. My first point will be about investment. So one thing that really interested me in the model was the emergence of inequality in the picture. And the model predicts that when you are in a situation of high desire to invest, the indebtedness increase as well as income inequality because of this income distribution, which is going into the pool of bankers. My question is, do you think that if the investments were made entirely toward productive activities instead of financial investment, the shift in the income distribution might be lowered, because then the bankers and other money managers will be less empowered by such investment? Or do you think that no matter the investment type, no matter how the money is used, in the end, just the fact that you have more credits allows banker to monopolize all capital?
My model gives the best possible outcome for capitalism in the sense that every last dollar that's borrowed is used to create productive capacity, which can generate a product flow that generates the cash flow that lets you repay the debt. So mine's the best of all possible capitalist worlds in that case. So if you include the real world where capitalists borrow to speculate, and of course they're borrowing money to gamble on rising asset prices, which is not increasing the productive capacity of the economy, it's trading profit only. So that actually accelerates the breakdown. Well, I've done a few models with Ponzi investment included. So I define Ponzi investment at the simplest level, saying which increases debt without increasing productive capacity. And you include that in there and relate that, say, to the rate of profit, which is the simplest way that I did it. So when the rate of profit rises, there's more Ponzi investing, then you get a faster breakdown. Okay. So including the real world factors of, speculative investment, speculative placement, not investment, as Black refers to it. You're not investing when you speculate. You're placing money, betting on the table. That will accelerate your breakdown. Equally, I think capacity utilization changes, same sort of thing.
Okay. And actually, my follow-up question is about speculation and renewable energy. Do you think that renewable energy is a speculative investment? Is the market of renewable energy not growing as fast as the investor believe it is?
Oh, we need. Sorry, yeah, sorry.
And also, like, just can your software Minsky conclude that we are currently facing a risk of green bubble? Is it something that you can do, or even in more general term, can we discover some kind of bubble with the software?
Oh, you can certainly model the bubble, and I mean Minsky can also pull in real data, and you can fit your models to real data. So it's feasible to fit things and say, is this a bubble forming in a particular sector? A lot of work to set up the sectors, but again, Minsky makes that easy with the godly tables for the financial side. You've still got to build the model of intersectoral dynamics, physical dynamics as well. Minsky is adding the capacity for vector differential equations, which will make that faster, but of course you've got to have your head around the idea of vector differential equations. So all that's quite feasible. In terms of what's happening right now, my own, because I'm working in climate change as well, and my own feeling is we're building renewable and non-carbon-based, so including nuclear, about 1/4 to 1/5 as fast as we need to. So it'd be quite feasible with what I've done so far in the modeling of energy to include a brown and a green energy source, and then have a rate of growth of the green and a rate of decline of the brown, and then see plus also your generation of carbon and your feedback effects on the viability of the biosphere, and do all that together and say, can we invest fast enough to do this? And what are, for example, the feedback effects on carbon generation of trying to build non-carbon based power systems using at the moment carbon-based energy inputs, all those sorts of feedback. So you would definitely want to model all those feedback dynamics and problems. And it's feasible to do it, but of course somebody else has to do the work.
Okay, I see. And I have one last point, which is maybe not very directly related to the paper, but one of your conclusion with the case of the bond, like bank regime, money and debt, is that banking sector cannot be ignored, that we have to regulate the banking, of course. But do you, firstly, precisely, what are you advising to different governments to implement? Should we limit credits? And if yes, is it even feasible? Because the banks have become so powerful the last decade.
Yeah.
Is it really, like, can we do it? Can we implement this kind of regulation? Like, even if we take into account banking, the banking sector in our economic models, will it change something in the end?
Yeah, that's a very good question. And during the 1930s, the answer to the question was yes, because when you look what Roosevelt did, he actually shut the banks down on the first day in office. Pretty good start. Okay. So the bank holiday began when he was inaugurated, and then that was go back through, check through the book, see where the bad debts are, do the consolidations, etc., etc. So you had a deliberate cleaning out of the banks and the management. Well, quite a few of the bankers in the 1930s ended up in jail, and deservedly so. Whereas their colleagues in the savings and loans crisis, if you know the wonderful character Bill Black, two of my favorite people, Bill Black and Bill White. Bill Black he was the chief prosecutor for the savings and loans crisis. He now teaches at UMKC. Wonderful, wonderful guy. You wouldn't think a little bloke like him as ferocious as he was, but he said he put about 200 people behind bars over the savings and loans. Yeah, okay. Now, fast forward to the 2008 crisis. How many people went to jail? One, Bernie Madoff. And Bernie Madoff could not be sent to jail. Okay? It was just too outrageous what he did. So that's the scale of failure of regulators and in the 2000s versus the 1980s, so let alone the 1930s. So you're right, the power is far too high. You'll only do this in the aftermath of a crisis that they've caused. And what Obama did was actually rescue the parasites rather than rescue the host, as Michael Hudson puts it. So that's the dilemma politically and financially. They're the ones, the capitalists, they would get rescued by the government sector when the government should be rescuing the real economy. So I'm proposing one of my ideas is a modern debt jubilee, and that would actually be an easy way of reducing the private debt and reducing the power of the financial sector while still giving them an income from the bonds that would be generated as part of the jubilee. So I'm trying to tame the financial sector, but you can only do it when they've been drastically weakened by a failure they caused. And we lost our opportunity in 2007. I think the next time it happens, it'll be in the context of an ecological crisis. So,
yeah. Okay.
It will, Steve, it will maybe happen before, because now we are gonna have, you know, we had this problem that we already pointed out 2 years ago, and the private debt issue is gonna be huge once the Corona crisis is over. But maybe we'll do that later on. But maybe we don't have to wait for so long. So Selma, thanks for these very relevant questions. Were complementary. So now I'm gonna open the floor, and I see Ramzi, who is our. You would like his profile. You know, Ramzi is an aggregate professor in mathematics, and he's fascinated by MMT. And of course, I was sure that he will have questions following your remarks. So Ramzi, the floor is yours, please.
Unmute.
Ramzi, open your microphone, please.
Okay. No, I'm not fascinated by MMT. I just study it, and I'm interested in studying it and the debates around it.
Sure, but you know.
Yes, my first question is just if you can re-explain the differences with MMT, because for instance, during your debate with Paul Krugman, when you say that the private banks create money, and so Paul Krugman disagreed, but here you had the same position as MMT, and so I was interested to know your nuances or differences with MMT, because for me, you and MMT said approximately the same things.
So I mean, I think I strengthened MMT by including the role of credit. That's one thing which they haven't yet done. So, this is no criticism of people to say they didn't come up with the idea. Okay, I didn't come up with MMT. I'm happy to use MMT. They didn't come up with the credit ideas. I'm happy for them to use my credit ideas. And the credit ideas are to say that just as deficits create money, so does net lending by the banking sector. And that credit becomes part of aggregate demand. Now that can be incorporated into MMT, and that's what I've done in the last set of slides I showed as well. So it's quite straightforward to include both forms of money creation, but it means that credit becomes a part of aggregate demand, and that's what MMT hasn't yet incorporated. I worked it out, and that's been my focus for my own work. And I want to work with Stephanie Kelton to write a joint paper on this for the American Economic Review and see if we can crack that particular nut by both giving a mathematical model of MMT, which everybody's been asking for, which I've derived, but also have a model of credit money creation as well. So Randy Ray had a fairly abusive exchange with what's his name, Doug Henwood, last year, I think it was, when Doug critiqued MMT. And as part of that critique, Doug said that there was no role for endogenous money in MMT. You're treating it as trivial. And Randy said, yes, we do treat it as trivial. All it did was explain that rather than setting the amount of money, central banks set the interest rate. And he said it was fairly uncontroversial to include that in your thinking. So the endogenous money wasn't controversial, whereas MMT is. Now, that's not including the role of credit in creating part of aggregate demand. Okay? So when you do it, credit is not trivial. It's a major part of aggregate demand as well, and it should be incorporated. So I just want to bring the two together. There's no clash. Like bringing my stuff in doesn't invalidate MMT. It enriches the overall explanation. So that's my positive criticism. The negative criticism I have relates to thinking about international trade. They have this little saying, exports are a cost, imports are a benefit. And that's another one of Warren Mosler's sayings. I'm sorry, it's garbage for a whole range of reasons. It implies, for example, that if you ship a Peugeot from France to America, then that's costing France because it's got one less Peugeot, whereas America's gaining a Peugeot in return for sheets of paper. That's quite literally the sort of example they give. That presumes factories are operating at capacity, okay? And you're losing a physical good, and that's really bad. Factories operate with excess capacity. We all know that. That's neoclassical bullshit to argue that they are operating at rising marginal cost. They've got falling marginal cost, lots of spare capacity. If you have export sales, then you use more of your capacity. So it's actually a benefit to the manufacturer for the exports. And then if you have an exports, whatever the mechanism, it's a complicated mechanism, but it forces your central bank to create more domestic money, which you can use to invest. And this is partly why countries with export surpluses have grown faster than those with imports, with more imports than exports. So I think that side of MMT literally contradicts MMT. If you look at it, if you look at the stock flow consistent modeling, where you talk about savings and exports and net exports and so on, it even contradicts that logic. So I think it's a bad piece of thinking which comes out of not being willing to contradict Warren. I am willing to contradict Warren.
Have you written something on this?
I wrote a blog post and replied to Bill Mitchell. It wasn't friendly, neither was he. So there's a bit of there's some awful ways in which bad personality conflicts get into economics. Danny and I can talk about it. We're good mates, okay? So there's strong friendships, but there's also strong animosities. And believe me, I'm not the only person who has problems with Bill Mitchell. I won't tell you who else has. I do know. You would be surprised. But these personality conflicts get in the way of developing argument, and you have people intimidating others and saying, that there's disparaging arguments. I'm willing to have a strong argument, but I want people to listen as well. And I find an unwillingness to admit you've made a mistake as being one of the weaknesses of humans in general, but it turns up here as well. That's a mistake. That argument, I think, is a mistake and should be thrown out. And I think I'm a bit disappointed with the economists, Randy and Bill and others, for not taking Warren on, saying, look, Warren, that's a bad idea.
Okay.
Yeah, he's been very friendly to the Epoch students a few weeks ago.
Yes.
But look, I can send a link to that blog post, actually. Danny, thanks for reminding me. I'll see if I can do a bit of searching on Patreon. I'll find that particular exchange. Okay. Yeah.
So Ramsey, do you have other questions?
Yeah, I had another. No, just on what you said, because I don't know, in fact, if Bill Mitchell really says that importations are good.
He did. I can give you page references. Sorry, okay. He did say that.
I thought. Okay. So my second question, it was about your comments on scientific paradigm and Kuhn, your comment on shifting paradigm in science.
Oh yeah.
I found your comments very interesting. So maybe you implied that the neoliberal paradigm will die when its proponents will die. Maybe it's what you wanted to say.
It doesn't. That implies in sciences. Unfortunately, it doesn't work in economics.
Yeah. So I was wondering why it doesn't work in economics, and so my hypothesis, and I wanted to have your opinion, that maybe neoliberal economics is not trying to say what is good in general or true in general for economy, but they are trying to say what is good for capitalism. And so they don't care, in fact, if they create unemployment, poverty, as long as the power of the bourgeoisie is maintained, it's good for them. And if one day they discover that they have made a crisis that is that is threatening their power, then this day they will accept some heterodox tool, but only to save their power, and just and their ultimate goal is not to have to say the truth or to have a good interpretation or explanation of what is economy, but just to support their benefits and the system. What do you think?
I think there's certainly a lot of ideology in defending the neoclassical perspective. You're not going to get right-wing American billionaires giving money to Marxists. So yes, they will select the voices they want to have loud, and that amplifies the message they're giving. But what you have is people who are willing to say this stuff for free and are very happy to then have themselves funded by an external think tank. So you need the believers first of all, the true believers, and that's where the neoclassicals play their role. They're willing to say for free what they say, and then billionaires are willing to give them money to say it louder. So they get amplified by the power system, but they also support the power system, because if you didn't have that religion defending the distribution of income as it stands, defending the power relations as it stands, it'd be that much harder to hold on to that power. So the priesthood plays a role, in other words. And I think that's the role that neoclassicals play. They're the priesthood, which doesn't say what it says because it's paid, gets paid because it says what it does.
Okay, thank you.
Thank you. By the way, I just found a link to one of my posts on my Patreon page, which is a talk by Bill Mitchell on exports versus imports. Somebody sent me a video of it, so I've included that link. And then around that, some point around that in my various blog posts, that's back in May of 2019. So it's at some point back then that I have that discussion about the role of exports and imports in the modern monetary theory.
Thank you.
Okay. Thank you, Ramsey. Other questions, please? So there are links, Steve has put links in the chat. So next questions, please. Don't be shy. I'm sure there are others. Okay, so maybe in the meantime, usually I ask my questions at the end, but maybe in the meantime to get some time to the students to think. I just wanted to ask you, Steve, this is something I want to ask you already in private. I always forget about that. It's not directly related to your paper, but the questions raised by Selma made me think about that. What do you think about the new cushions that have been added to Basel III? Because it seems to me that the counter-cyclical cushion and the cushion that has been added for the global systemic GSIBs, global systemic, I cannot figure out what the it means for the GSIBs, so the big banks, they have really a Minskian flavor. Especially in an institution where people like Borio also publish papers, the BIS, that have a Minskian flavor. What do you think about discussions? And just for your information, what the big banks did a few months ago is to try to get rid of discussions at the European Parliament to impose, you know, the relevance of discussions for GSIBs and for these counter-cyclical questions. What do you think about? Do you have an idea about this? And the second question I want to ask is about the current state of Minsky, because the last time we discussed about this, you showed me a bit, but do you have Steindeinian effects now that is, you know, that would counteract the Minskian effect So situations for some firms where getting indebted allows them at the end of the day to reduce their private debt or not. Because I think, you know, you always have these two effects, and I agree with you that the Minsky effect is greater, but you also have this Steindalian effect, and it's there. And as you know, I've done some work showing that whether we'll have a crisis or not depends on the size of these two effects. So where do we stand on that point?
Oh yeah, well look, on the first, I don't follow BIS Basel rules too closely, so I can't really comment. I just expect any regulation changes to be gamed. So my mind is reforming the banking sector, have the effect on restricting. This is actually answering one of Selma's questions in a bit more detail. I would want to restrict lending that finances asset purchases to some multiple of the incoming generating capacity of the asset being purchased, which would take away the positive encouragement we currently have to get into more debt, because if you and I are fighting over the same apartment on the Champs-Élysées, if we were so wealthy, then the one who got more debt would be the one who won. So I want to make that the other way around, that is the maximum amount of debt you can buy based on the rental, prospective rental income of the property. Neither of us can borrow more than that, so the one who wins saves more money. That sort of thing. Make it possible for banks to lend to entrepreneurs by taking a capital stake rather than a loan stake. So you encourage some lending to entrepreneurs. Take away the encouragement to speculate on shares by having shares expire once they've been on the secondary market after a number of trades, things like that. Structural reforms rather than regulations, because the banks will always game the regulations. I've spoken to plenty of bank executives who told me that they get invited to the Bank of England to discuss the next set of regulations, and while the regulations are being explained to them, they're spending their minds ticking over, how can I evade this one? Ah, that's right, we'll do that, you know? So it's crazy, you can't control them with regulations. Minsky stated, I'm a bit lost with the two questions they made, pardon me, a bit late at night for me right now, but Minsky sophistication is getting high enough for me to be willing to recommend it for people that do their PhDs using it. There's still elements we wish to expand its capabilities on, but things like the modeling you want to do is quite feasible inside Minsky now. And what we've added, for those who know this area, is a whole lot of tensor operations, handling not just matrices, but multidimensional arrays for data processing, for simulation equations and so on. So it's got an enormous amount of power now, and really it's a case of teaching people how to use that power. And unfortunately, I've wasted so much of my time fading neoclassical, I've forgotten most of my vector mathematics, so I'm not the one to teach it. We'll have to get Russell or somebody like that in there who's actually done the code. I'll actually quickly show that if I can. Just if you go back and share screens for a moment. It's amazing how the GoToMeeting seems to disappear.
You can still share your screen. You're still a presenter.
Yeah. Okay, so I'll go back and bring that up. So share screen. Okay, share. Right, and I was actually just want to show the operators here. So that's inner product, outer product. I don't know what index is for. A gather operation, again, I'm not sure what that is. I'll just tear this one off so you can see the operators turning up over here. We then have running sums, running products, difference operators, etc., all of which you can use to build large-scale models, in addition to the basic usual scalar operators. As you can see, all the usual mathematical operators here. It's got an enormous amount of power. We're still fine-tuning how that power is applied, but if you want to do a multi-sectoral model of the economy with numerous vector operations going on, it's quite, I won't say it's easy to do, but it's quite feasible to do. Now I'm looking again for those controls to hand back. There we go, press the escape key. That should do it, I think. Let's say that. Hasn't, okay, stop sharing, boom. That's it, lots of power is there. So looking forward to people starting to use it.
Okay, that's great. So a few last questions. before Steve can finally go to bed. Thanks for staying with us so late. Guys,
Welcome.
Nobody else?
I maybe have one more question.
Yes, Selma, go ahead.
In the conclusion of the paper, you speak about the fact that you're working on adding government sector and in the model. And I would like to know, you can already share with us some insight you get from this new.
Well, that's actually, I did that back in '92, so it's a long time ago. So it's quite. I added just basically by including the basic equation that GDP includes government spending, and I then had government spending driven by a desire to reduce unemployment. Okay, and so when I add that into the system, then I get a stabilizing effect. So if I can bring up, my paper from the Journal of Post-Keynesian Economics, which is the paper I wrote. I wrote the paper in '92. Paul Davidson didn't publish it till '95, so we became friends after that. But it was a bit annoying at the time. But anyway, so this paper should have been out 3 years before it was published. Let's see if I bring it up here, and I'll just actually go through and find that section, and then I can come back to your question. Okay, but when I include, let's see, I'll go back and try to do my sharing again here. So everyone, I'm trying to find the, oh, share, that's right, sharing screen. Okay, here we go. So if you look at the model, I brought in government spending and taxation being functions of the employment rate and the profit rate, and then a government debt function here. And when I fed it in, it actually gave me a model that behaved in quite a remarkable fashion with what I call a toilet bowl in space. This cone of, so you had cyclical stability, sort of thing Minsky would have been very pleased about. The government didn't stop at cycles occurring, but it stopped a breakdown occurring. And I realized you have to have nonlinear functions to do that. If you have linear functions on top of linear functions for the other elements, then you get just crazy dynamics coming out of it. You have to have nonlinear functions at that stage to include the government sector properly. But it's quite straightforward to do. The equations aren't exactly easy to see. They'll actually make them make them larger. Let's see. So I just had equations for taxation as a share of GDP and government spending as a share of GDP. The functions aren't turning up properly because of hassles with Adobe Acrobat, but you'll find that in my 95/92 paper. And pardon me, I'd be happy to have that extended further, as I said.
Thank you.
Okay.
Last interesting question. Yeah, another one?
Yeah, another one. When do you think that this addition will make it possible to conclude that government can have another role than just being the last savior between an economical termination, in a sense?
Sorry, I missed part of the question. My hearing is bad. Can you just try that question again? Sorry.
I was asking if maybe the fact that we add the government sector in the model will lead to a conclusion roles for government, and then not just the role of the last savior between the end of the economical.
Yeah, I mean, yes, it's argued a positive case for government involvement, and this is, and like another thing which I can do it in a logical sense is to say, if you consider assets and liabilities as claims on other people, leaving out assets which you own outright. You know, if your skateboard collection is not an asset which is a liability for anybody else. Okay. I can think of circumstances where it might be, but we're talking about your claims on Raphael and Raphael's claims on Ramsey and that sort of thing. The sum of all of them comes to zero. Okay. The assets minus liabilities might equal zero is the overall rule for a double entry bookkeeping. And then if you apply that at the aggregate scale, then the sum of all claims of other people and other people is zero. Now then if you say, well, What about the banking sector? Let's divide the world into the banking sector and the non-banking sector. To be a bank, you must have positive equity. So if the banking sector has positive equity, by definition, the non-bank sector has negative equity, precisely the same amount. Okay? They balance each other out. So if you have a private economy, only private money economy, the non-bank private sector is a negative equity. Now, our reaction to being a negative equity, we don't like it. Okay? Our liabilities are greater than our assets. Not a comfortable situation for anyone. What do? We go and borrow money from banks to gamble on asset prices and drive them up. So in some ways, a pure credit economy gives you a reason for the non-banking sector to speculate and gamble. Now, when you include the government sector in there, the government is the only institution which can cope with permanent negative equity. Okay? This is the elaboration of the MMT point, because MMT talks about individual flows. I'm talking about the aggregate of net worth overall. So the government sector can afford to be in negative equity, which means it puts the rest of us in positive equity, exactly the same plan. So if the government sector is in negative equity, the rest of us are in positive equity. And if the government's in big enough negative equity, then the non-bank sector can be in positive equity, and so can the banking sector. And so a large government sector, government system, with running substantial deficits, can reduce the encouragement the private sector has to speculate and gamble. So there's a philosophical, if you like, structural reason to be in favour of a large government sector as well, to reduce the tendency for wasteful speculation, gambling by the private non-bank sector.
Thank you.
Welcome.
Very fascinating. So if there is a last question, this is the moment, you know, it's always like in a marriage, right? Speak now or keep silent forever. Last question. Oh, Augustin. Augustin is also an interesting profile. He's going to be my intern, and he has a PhD in biology, and now he's interested in products economics. Augustin, do you have a question?
Yes, maybe a large question. Can you hear me?
Yeah, we can.
So I'm about to do SFC models in discrete time, and what do you think?
No.
Yeah, okay, that was the question. What do you think about the fact of discrete time?
I hate discrete time. Okay, I've done mathematics courses in discrete time, so I know what I'm talking about. Discrete time is a totally inappropriate framework for modeling macroeconomics because it implies a level of synchronicity in consumption and investment decision that simply doesn't occur. If you have discrete time, you're saying all investments occur at a particular point in time, period, okay? Secondly, if you do discrete time properly, then you have to work out what's the discrete time frequency of investment, what's the discrete time frequency of consumption, okay? The answer would be consumption maybe 2 to 4 weeks, investment maybe 2 to 4 years. So if you're using T and T minus 1, you should have T minus 2 for consumption, let's say, and T minus 104 for investment. And then if you find, oh, we got it wrong, it's not every 2 years, it's every 1.5 years. You've got to go to rid of the whole damn model to make it T minus 72, which nobody ever does. They all use T minus 1, so you take consumption on last year's income, which is garbage, okay, et cetera, plus also all the change occurs between the periods. Okay? Now, that's why I think it's taken post-Keynesian economics so long to get its head around the role of credit. Because if you're thinking in discrete times, there's no change in credit through the time period. So I think it was actually an intellectual, even though it's better than an equilibrium thinking, it's an intellectual constipation that stops you thinking through the actual dynamics of capitalism. And this is because of neoclassicals. It's not our fault we use discrete time. I just recently had a look at, I think it's Thomas Sargent, or what his name is. There's Lucas and Sargent. He has 2 textbooks he gives away for free, running a set of courses, macroeconomics and advanced macroeconomics. A couple of, at least 1,000 pages of PDF text. 2 pages on differential equations. The other 998 are difference equations. The only 2 pages on differential equations are explaining the dynamics of the Samuelson model, and that's they get it wrong. So you know, it's economists have built their own rickety load of garbage based on equilibrium thinking and then period analysis and so on. It's an embarrassment. They think it's sophisticated. Jesus Christ. So like, let's get rid of it and do continuous time.
Yeah, this is a debate not between
Sorry, I've had this for 20 years, so you know.
Also inside of the heterodox.
Yeah.
The heterodox people. You might not know that, Steve, but Antoine has moved to your position. He didn't have this kind of position 2 years ago. We had a very long discussion recently about that.
I won.
He's trying to convince me that we should now move to continuous time. But the question then is that I'm sorry, but macroeconomic data for most of them, except in the US, are yearly data, right?
Oh, terrible. I mean, same thing for population. That's why biologists model all population change as discrete time. They do not. Okay. It's this is what Wynne Godley said to me as well, and I said, Wynne, for God's sake, you know, just because the sampling frequency is bad doesn't mean after the mathematics is also bad. You know, if we actually went across to, maybe we used to using FPOS data to start building GDP, all of a sudden that argument would be useless. Okay, so it's a bad argument. And you know, Antoine, I know Antoine actually has gone across to continuous time because he totally had no choice by my great friend Gail Girard, who said you can only work on this if you work in continuous time. So another mathematician struck there. So the data, the best way to fit an asynchronous system. This is the major point. Capitalism is asynchronous. One investment does not occur at the same time as another investment. The best way to handle that is at the aggregate level is a set of first order time lags. And if you do what I talked about a moment ago, if you have consumption based on spending a couple of periods earlier and investment based on a year earlier, then you have a time constant of 0.05, let's say, for consumption and a time constant of 1 or 2 for investment. And if you then find it changes, you have to change the scalar, which is nothing like having to change the structure of the whole set of equations. So there's all sorts of advantages for continuous time over discrete time, even when you want to bring in time lags, which are quite straightforward in continuous time systems.
Okay, thank you.
Okay.
Okay, thanks for these interesting answers.
Not all.
It reminds me of debates I've had a few years ago with Amit Avedat. We discussed that a lot, you know.
Yeah.
And you know that Marc Lavoie tends to err on the other side, even if he's open-minded. Like
Mark's a great guy. So yeah. All right.
Is there anything else, or is it time to go to bed now?
Time to go to bed, I think. I think just suggest students follow my stuff on Patreon. The Patreon page, of course, it's what I earn my income through these days, but most of my posts there are open access. You can just go and you don't have to pay me to read them. So I'd like people to get in there and take a look at them. And I'd really be delighted if you download the Minsky software and start playing with it. And particularly if you do so, try to do modeling in it and join the beta testing group and give us feedback on bugs and improvements that are necessary as well.
Okay.
Okay.
We'll try to organize this. Thanks, Steve, for staying so late. Thank you, Stu, for staying so late also, but even if it's earlier here in France. It's time to say goodbye, to wish you all to spend, despite of the context, the best holidays you can, and see you again on the beginning of January, and we'll try and organize a tutorial with you, Steve, because I'm sure there will be lots of questions.
And send me the recording too, thanks. Send the recording, thanks, Danny. I'd look forward to seeing it.
I definitely will.
Okay, bye all.
Good evening, everybody.
Thanks.
Thank you very much.
Goodbye. Thanks again.
Thank you.
Bye. Thanks. Goodbye. Goodbye.